Alright folks, finally the video on futures market. I'm going to do this in two segments so that if the recording shuts down, as it's prone to do, and the IT people can't figure it out, I won't lose an entire lecture. Also, let me just say once again, tomorrow's video will be over Chapter 2, responding to your questions. Many of you have not submitted them, and I have deep suspicions that you do not understand that entire chapter, yet you're not posing questions. Not a good idea. Chapter 2 is central to this course's topic. You must learn that analytical way of thinking. I'm teaching you thinking, not preaching. And it will be heavily represented on the second quiz. So let's get it going, folks. The first quiz, by the way, will be submitted on Wednesday. I'll send you the rules on that later. Alright, we're going to look at futures market. Futures markets, and you're playing a futures game. In fact, I want your commodity that you're going to bet on by the end of this week. You don't need to do the entire bet. We'll wait till next week after you're done with the quiz, but at least pick the commodity. Either oil, gold, or dollar versus the euro. Not pork bellies, for which they make bacon. Futures markets, and the biggest one is in Chicago, another one in New York. London has a metals market. These markets really determine, and to many people they are not happy with this, they really determine world prices for commodities. Gold, oil, corn, wheat, rice, platinum, you name it. The prices that are paid for those products, either high or low, are basically determined by the futures markets. And there are some distinct winners in that, and there are some distinct losers. And for obvious reasons, the losers don't like it. But that's what exists, and futures markets have existed really for centuries. The first one in the modern era having begun in Japan. But now they're everywhere, even in China. They are regulated to ensure that rules are abided by, so that markets don't implode as they did a couple years ago. Keep in mind, the subprime market and the credit default swap market was not regulated, and we saw the results of that. What futures market is. Again, free markets, in order to function, need regulation. It's like free people, in order to travel by road, need to have road signs, police, and rules, which unfortunately too often people don't abide by. So what's the essence of a futures market? Well, the first thing about a futures market that you need to understand, I sent you an outline. There's a very extensive reading after that, but you may not want to try all of that. It's excessive detail, but take a look. Reading never hurts. Futures markets are unlike a stock market in a very significant way. In the stock market, although there are stock futures as well, but let's put that aside for the moment. In a stock market, you basically win, an investor wins by having a stock rise in value. If the stock drops in value, you lose, particularly if you sell the stock for less than you bought it for. But in futures market, and it's explained on the outline, and I will go through that here, you can actually win in the market, that is, earn a profit, and we're all after profit, When the price of the commodity that you're betting on, it literally is a bet, an informed bet, hopefully, but still a bet, a little bit like a casino, more like poker than crap shooting. I don't gamble, but my wife from China does. Everybody from China gambles. I'd like to know why that's the case. I've never figured it out. Anyway, keep in mind the biggest gambling center in the world is not in Las Vegas. It's in Macau. About 5 times the size of Las Vegas. So, you can bet that a commodity is going to drop in value, something called a put, or to go short on the commodity, and actually earn a profit. But you can also do it the way it's generally done in the stock market. You can bet that the commodity is going to go up in price and earn a profit. Now, futures are over a contract period. A contract is established between you and another party. You are the holder of the commodity, and you are going to sell it at a particular point in time, we'll say at the end of the semester for our purposes, our game, to that buyer. Both of you have an interest in it. You have an interest because you're going to bet that the commodity either rises or falls in value. And the buyer has an interest in being guaranteed a certain price. And that's crucial, which is called a hedge. Buyers agree to buy a commodity at a certain price 3 months ahead of time as a hedge against wild price fluctuations. And in a sense, that's why futures market exists. So there are 2 ways you can go about betting in the futures market, although many future traders do both. One is called a call, or to go long on a commodity, meaning that you're betting usually over about a 3-month period, though you can buy or sell parts of a contract any day of the week. In Europe, it has to be 3 months, but here you can do it at any time. But we're going to do it till the end of the term. I'll make you all rich. You're betting that the price of that commodity is going to go up in value. That, let's say, if oil is $80 a barrel today, you're going to buy, as I said in my outline, 20,000 barrels at $80. And if after the 3-month period, the entity that you signed the contract with to buy the oil, if the oil has risen to $100 a barrel, well, you make $20 a barrel, or by whatever amount it rises. Of course, the more the better. Now, why would a buyer make an agreement with you to buy oil in 3 months at $100 a barrel rather than the $80 now? Because the buyer may fear that the oil could actually rise higher in price, and you're guaranteeing to sell it to the buyer at $100. No matter if the spot price for the oil that day is $120, you're going to sell it for $100. So the buyer is hedging against risk. Oil, like many commodities, but particularly oil, can really roller coaster up and down for any variety of reasons, political, economic, you name it. The put is where you think the price of the commodity is going to go down. Now, the decision on this is made after exhaustive research. If you're in a firm that does futures, and keep in mind that George Soros, one of the richest men in the world, at whose apartment I had dinner one night, I invited him to come to Adelphi. He said, forget it. He's made billions of dollars by reading the market well and making huge amounts of money on futures trading. He once shorted the pound and made billions of dollars, which is why the British won't allow him back in the country. And the futures market is not for the faint-hearted, because the movement of these commodity prices is relatively small over an extended period of time. You have to bet tens, if not hundreds of millions of dollars. Soros told me one week that he had bet something like $1.3 billion on a particular commodity. He didn't tell me because he didn't want me competing with him, as if I could bet $1.3 billion. Indeed, futures traders keep their information very close to themselves. They don't share it. If they think they know something critical to where that price is going to go, possibility of a coup d'etat in Venezuela or something and cut off oil supply, they're not going to let you know it. And if you saw the film, which was about futures trading, called Trading Places, you see the way in which, in that case, the weather report on oranges became almost like a national secret, something like nuclear weapons codes. Because if you knew what that weather report was before everybody else, you could make a killing. Which the criminals in that case try to do, but they get frustrated. So now with a put, you believe that, let's say, oil is going to go down to $60 a barrel from its current $80. You don't buy the oil at this point because it's $80. You wait until the day the contract is up, and you go on the market, the spot market is called, and you buy the oil. And if it's at $60 a barrel, indeed it has dropped, your contract partner has agreed to buy it for $80 a barrel, which he or she must do. And again, you make $20 a barrel. And you multiply that times the number of barrels you have, times a factor of 10. 10 is the factor by which profits or losses are multiplied in the futures market, which is why you can either make big money or lose big money. And that's why when you do your bets, folks, don't bet a lot of money. You only have $1 million. I wish I had $1 million. You only have $1 million. And if you bet the wrong way, if you do a put, and the commodity is going up, not down in value, and your million can't cover your losses at any point in time, your broker, because you have to go through a broker, just like buying stocks, will force you to close the account and take a huge loss. So some of you who've already tried this, I said, reduce the amount you bet, at least initially. You can always up the bet later if the price of the commodity seems to be moving in the direction that you anticipate. But if it's moving in the opposite direction, you've got to cover your losses. And you only have $1 million to work with. In reality, as I just sort of indicated, futures traders bet tens, hundreds of millions of dollars, even billions of dollars, because the price of many of these commodities over a period of time may be less than 1%. So to make any real money, and there are fees involved, you have to bet a lot of money. Again, the futures market is not for the faint-hearted. So that's basically how the markets function. You will choose a commodity. On the day that you choose it, you look at the price, say the price of oil per barrel, quoted in dollars, and you will decide that you think it's either going to go up or down. If you read some articles on it, it's fine. Everybody's predicting gold is going to go up now. It went down terribly last year. And don't abide by the false notion that the prices of these commodities always go up. Far from it. Oil is not at its all-time high. And certainly gold isn't. Last year was a terrible year for gold. Basically, gold goes up when there's fears of economic disruption, particularly inflation in the world economy. Dollar and euro, well, a lot of that has to do with the strength of our economy, the demand for dollars, which pushes the price higher, versus the demand for euros. Remember, Europe as an economic entity is larger than the United States, more people, etc. But countries like Greece have had some severe problems, and so the euro, although it's higher than when it was first issued, at 1-to-1 to the dollar, has dropped. But in recent weeks, I think, I don't really track it, the euro has gone up in value. But that doesn't mean it's going to go up in value over the period of time that you bet. Now again, virtually every commodity price is determined by the futures markets. And as I said, there are winners and there are losers. The biggest losers, unfortunately, tend to be poor farmers cultivated in the poorer parts of the world. For example, cotton farmers in West Africa. West Africa produces a lot of cotton. But the problem is the price for cotton is determined by forces that the West African farmers have very little, if any, influence over. And if their costs go up, particularly of water, because West Africa is being hit severely by drought, I wish they had some of that water that's inundating Britain right now, as does California. Yeah, there's no climate change. Sure. And cotton demands a lot of water. My mother, in her farming years out in California, tried to grow cotton. Then we tried to pick it. No wonder the slaves revolted. It tears up your hands. And so cotton farmers have very little influence over the price of cotton. I'm going to stop here and start a new video so I don't lose this one. Be back in a few minutes.